All right, everyone. Welcome to this CRE News and Views morning show. And we have our esteemed panel in the house. We have Susan and David and Hector and Emil, who's trying to connect to audio. He's in Poland, so just give him a second. He'll do that. So this show is all about commercial real estate, what we're seeing in the market. I've got some lovely experts in the room in all sorts of areas. We got Susan. I'll let them introduce themselves. And Susan's in multifamily, and David runs the Daily REIT Beat, and Hector is the co-working guru. Is Hector Kolonis, and Emil, whenever he connects to audio, is a developer in Warsaw, Poland. So we're gonna have a fun conversation today. So I will start. I will let Hector, you can introduce yourself first, and then we'll go around the room and talk commercial real estate, man.
Awesome. Hey, everybody. I'm Hector Kolonis. At my day job, I work at CRE, where we help people who run multi-tenant buildings connect all those systems that don't connect. That's what my day job is. It's very geeky, very involved with the tech side of things. But in that spare time, I write a newsletter called This Week in Co-working, where I look at the trends and market moves and the undercurrent things that are happening across the flex workspace industry. Great to be here. I'm excited to jump into the news.
Yay, awesome. And Miss Susan?
I'm Susan Girock. I'm the Chief Information Officer of Elm Communities. We are a multifamily REIT based in the Washington, D.C. area with properties in Maryland, D.C., Virginia, and Georgia. And I love all things technology and commercial real estate.
Awesome. Thanks for being here. And David?
My name is Dave Auerbach. I am the Chief Investment Officer of Hoya Capital. We run two publicly traded New York Stock Exchange listed REIT and real estate ETFs, the Hoya Housing 100 ETF ticker HOMES, HOMZ, and the High Dividend Yield REIT ETF ticker RIET. I'm the publisher of the Daily REIT Beat newsletter. I just launched, Susan will like this, I just launched www.allthereitjobs.com this morning. It's the first REIT industry jobs website that is a current work in progress, but we have gone live, and I'm a REIT industry consultant.
Very cool. Well, and I am Amy Palvido. I am the founder and CEO of Basilomax, a real estate technology company, and I also am the chair of the U.S. PropTech Council. And I have been in commercial real estate for 21 years. So this will be a fun conversation. And we lost David's face. That's awesome. All right. So one of the first things is we were talking about with David, and anybody, y'all can all chime in on this one, but the large REITs, and a lot of them have PE funds. So the whole run on the PE fund is happening at the moment. It's one of the big stories. And there's large redemption queues for the funds. Starwood has basically severely limited the amount of money that they'll give back to their investors. And Blackstone has taken a different approach. But David has some really cool insights into this. But basically, everybody's invested in real estate, basically wants their money back and want to get out of the market. I don't know what's happening, you know.
Well, I don't know if I necessarily agree with that statement.
Just kidding.
Real estate does go through cycles. The public REITs tend to lead the privates on what's going on. Right. And when the private REITs were acquiring all sorts of assets, during and coming out of COVID at ridiculous cap rates with basically free money, the world's a different place several years later. And in order to monetize, these guys have to sell assets, refinance, gate redemptions to prevent investors coming out so they can keep money. And the other issue is that obviously they were all financed with variable rate debt. And so those that were exposed to variable rate debt are obviously feeling the pain today. But in the same breath, as I was sharing with Amy when this started, there's a firm called Robert Stanger. They cover all of the major non-traded REIT real estate platforms. And they upgraded one of the guys this morning, KKR. KKR's Real Estate Select Trust to overweight. And they talk about, some of the steps that KKR is putting into place that kind of differentiates themselves from a Starwood or a Blackstone. As an example, KKR is putting $50 million into the REIT. They've agreed to potentially forfeit up to 7.7 million shares, currently valued around $200 million, to support a $27 NAV on June 1st. So they talk about the fundamentals being sound, and basically the discount that this quote unquote stock is trading at to its net asset value. But whether it's public, whether it's private, many of these REITs, if not most of the REITs, own the best properties in the best markets at the best intersections. And so as a result, whether you're going through some distress or not, these are still some very desirable assets that many both publicly traded REITs and private REIT guys would love to get their hands on if they had the opportunity.
Yeah, I agree. I mean, they had the luxury to pick the best with, of what they had at their funds at the time. I know the $4.7 trillion pile of outstanding loans, because it was all cheap debt at the time, is a big thing that's looming over everybody's minds, right? As those things come to mature. So it would be really kind of interesting to see kind of where that goes. It's yeah, I don't know. So what other REIT news do you have, David? What else
There's
you got
still
coming up?
activist battle going on at a Houston-based shopping center REIT called Whitestone. There's a firm called MCB Real Estate that's looking to potentially raise their bid for the company. Whitestone's been going through a couple of activist campaigns. There's several REITs, publicly traded REITs, that are going through activist campaigns currently. Right now, a lot of people are trying to position, let's say, coming out on the other side of this, when and if the Fed does cut rates, it's time to start looking at REITs today, because, and I think Susan would attest to this as well, most of the REITs continue to raise their dividends regardless of what's going on in the world of interest rates and the 10-year treasury. It's business as usual. Higher for longer has gone out the window. It's now just high for long. And so a lot of these guys are, know this is the current environment. But not to steal Susan's thunder, but from where I sit managing two of these funds, we still see massive opportunities in the world of residential REITs and real estate due to the home affordability and what's going on out there in the world of mortgage rates. And we could talk about this ad nauseum, but we still see a lot of opportunities and upside in many of the residential REIT sectors, including apartments, single family rentals, senior housing, student housing, the list goes on and on.
Yeah, I feel you. Susan, you want to add to that?
Not a lot to add. I will say that I was reading a really interesting set of reporting from BizNow at the end of last week and beginning of this week, where they had asked a lot of people in the real estate space, because everybody was saying survive till 25. Like that was the phrase. That was the phrase. And so they've gone back to people in the industry and said, all right, come up with something new. And some of the things people are coming up with are hilarious. I'll try to look some of them up if I still have the email, but there are people even coming up with sayings for 28 at this point.
Wow.
Yeah.
Wow,
So
really?
it's I think that the year certainly hasn't necessarily gone as anybody planned, with the hoped interest rate cuts and things like that are important to our industry. But I agree with David that there are, there's still a lot of opportunity out there, for organizations that can act on it.
Yeah, no, for sure. Right. There's, I think, what was it, in 23, everybody was like, oh yeah, all the people were just waiting. They were waiting for the flood of the properties to happen. They were waiting and they're waiting, and they were just going to pounce on them, right? And I have we seen the flood? I think we're starting to see transactions. I was talking to a multifamily broker last night. Good friend of mine, he's been around in the business for about 30 years, and he's like, yeah, we're starting to see transactions happen now. And it's because stuff's they have to transact, right? They have these loan maturities and they have to do something with it. So it's really kind of interesting to see. So hopefully that works. That's awesome. So the next story I want to talk about was, you know, and I don't like to get political, but this is just hilarious because it's called Trump Wasn't the Only One. So this story was about all the fraud allegations that are starting to come out now that people or that especially around Fannie Mae and Freddie Mac are trying to find, and they've blacklisted some people, and they're starting to see now that you could peel the layer back of you know, the properties are not doing well, really truly how these loans are structured and how they were kind of put together. And they blacklisted some very large lenders in the space. Meridian Capital is one of them, and I think Meridian Capital's having to restructure a lot of their stuff in the multifamily space. But it was and there's other like real estate companies that they're looking at around very blatant fraud when it came to getting loans. I don't know if y'all have heard anything about any of that. Hey, Judy, you're here. Sorry, I've been busy.
I can't put my face on today because of the time versus my workout. Sorry. But I know you're totally what I look like when I've gotten dressed.
Yeah, so Judy's our resident Californian, and it's really early in the morning for Judy. She's our resident West Coaster. But anyway, so it was really interesting to see that you know, obviously there's when times are good, it allows for certain things for people to kind of look the other way because they just want to do the volume, they want to do everything. It was interesting to read that in the news lately about how now that things are starting to get bad and really starting to take a look at their loans and things aren't going well, they're truly finding, you know, the stuff under the, you know, covers of the stuff that wasn't, you know, fully transparent. It was really kind of an interesting article for me. So Hector, there's another article about WeWork. I know, you know, this all seems people seem to be talking about. What are you hearing about post-Yardi acquisition, and are they doing anything majorly different? Because I see some moves where WeWork is not really kind of, you know, they're rejecting some leases, they're doing some different things, and I'm just curious that under Yardi's new leadership, if you've seen any difference around WeWork.
Great question. I mean, I don't normally like to comment on specific companies, especially when they're public. But WeWork is definitely in an interesting place given the fact that a tech company has essentially acquired the majority piece of it. They are obviously, with the tech company doing it, there's going to be some sort of retooling that's going to allow for more market efficiencies. As you said, they did let go of a lot of underperforming assets, which many folks who've been observing this, folks like Professor Scott Galloway, was saying that, you know, any retail industry business that goes into bankruptcy allows you to get rid of the underperforming assets and come out as a stronger business on the other side. So we're definitely watching to see that. There are some interesting findings in their reporting. The fact that obviously they've reshuffled their board and they're doing some interesting things there. A lot of Yardi presence on their board, which is a very tech-focused board now, as opposed to the previously more real estate-focused board. I do think we're going to see a more asset-light version of WeWork coming out, trying to figure out how they can place their contracted businesses into spaces that they don't run. I think that's going to be an interesting move from them. There was also a data drop this week from a Yardi affiliated site that actually shared the largest US co-working operators, in which WeWork was only third. There was actually out of the top 15 that represent around 2,000 plus locations, you had Regus and HQ at first and second with 972 and 204 locations, then followed by WeWork at 173, Industrious coming in with 145, and they're on a massive tear, expanding through partnerships with multifamily and other communities. Premier Workspaces sitting at 86, Office Evolution, Intelligent Office, and Vast, and VentureX, they're all part of a franchise network called Vast Group. They're also on a tear. They took 3 of the places in the top 15. Then you've got Expansive and Lucid and Serendipity Labs all growing as well. So you've got this really big expansion in the number of locations that aren't WeWork operated. Everyone added locations except for WeWork, who dropped 73. So it's an interesting shift in the US market. They are doing some very interesting things, but I definitely think focusing on one brand is an incorrect strategy when looking at Flex, especially with regards to the deals they're making in commercial real estate. Many of the brands I mentioned in that top 15 are no longer doing lease agreements. They are doing partnership agreements. They are doing buyout agreements. Expansive, for example, who owns most of their buildings, are now expanding into a lot of partnerships with landlords who have underperforming assets. And we're seeing a lot of moves in this direction, a lot of landlords coming into the market and buying franchises, bringing that into their buildings as opposed to signing leases or signing out leases. So a lot of different strategies at play. I think going back to what Susan said, surviving until 2025 is no longer the only option. You need to fill those buildings. You need to show footfall. But this is all against the undercurrent that hopefully in the next couple of months, if Blackstone offloads the office group in the UK, there will finally be a valuation for what a Flex floor plan is worth. Because up until now, the capital markets treat a co-working space or a Flex space as a zero income space. So when you value a building, any floor that has co-working on is valued at zero. If a large firm like Blackstone manages to offload that asset, you suddenly have a valuation, which means you can now go back to the capital markets and say, we have 3 floors of co-working, it's valued at X per square foot, let's renegotiate our rates, let's renegotiate our cash infusions. So we're seeing all of this at the undercurrent, it's all bubbling up now. There are 3 other kind of acquisitions of a similar type that will allow the markets to finally put a valuation on what a co-working space is worth from the capital markets purely, not on a VC funding basis. So all these things are happening at the same time. And then just the last piece around co-working is obviously Blackstone has now acquired a hotel group that also owns a co-working group. So that is going to come into that whole the office group structure deal thing. So a lot of moves being made behind the scenes that aren't related to WeWork.
Yeah, no, true. That's very true. I like that the whole idea of the mixed use. Obviously the co-working spaces working in the multifamily arena for sure. I mean, I think it's becoming more of a. Do you have any co-working space, Susan, in any of your properties?
We do not, but I was in Tampa for RealCom last month, and the Water Street Tampa organization that has really basically redone that entire area in Tampa. At least one of their multifamily buildings does have co-working space in the building.
Yeah,
so it's definitely something I think you're seeing a lot more of, especially in some of the newer construction.
Yeah, for sure. So it's public facing, so it's a public retail or office space okay, interesting. Yeah, for sure. The similar phenomena that happens on the co-working side also happens on any sort of like multifamily or residential where there's a short-term rental. It's the same thing. A lender looks at it as like zero income. Like, forget it. We're not going to even do it. And so we're not going to consider it. So it makes it really difficult. I hear you on the making it difficult. But so that's good news that Blackstone might have a valuation for co-working, right? I mean, that's going to change the game as far as that goes, for sure. That's awesome. Hey, Emil, how are you? How are things in Warsaw, Poland?
Everything's fine, thank you. Hello, sorry for being late. I've just ended up the negotiations about multifamily design agreement. So
very cool.
Yes, we are about to deliver to the market more or less 77,000 square meters of residential square meters. I don't know how many is
that's feet. 200 and times 3, 200,000 square feet of multifamily. Okay. All right, that's a couple of units. That's 1 or 2, but just a couple. Yeah, no, it's all good. So what's happening over there is there any sort of economic development outside of France because the Olympics is coming to Europe? I'm just because it's happening. Has there been or no?
Actually, I haven't felt such a thing. Recently, I've been in Marseille, south of France. So only one thing I experienced was the prices for the Airbnb, even in Marseille, which is let's say, I don't know, 700 kilometers from, or maybe even more from Paris. It's skyrocketed. But what it cheered me up when I've been to Stockholm for the business trip also. Stockholm was much more expensive than Marseille, France. I don't know what's happening in Stockholm, but the prices are out of mind. Especially, I was depressed because I've never done, I didn't do the business there, and I paid a lot for a for a flat, living there for 5 nights. So I was really, I don't think so. I'll come back to Stockholm within a few upcoming years. But architecture, I liked. Urbanism of Stockholm, I liked. I really recommend it. It's like a lot of water, like a kind of Venice of Northern Europe.
Very cool. No, that's awesome.
We're going to Paris during the Olympics by accident.
You are? Did you
What?
not? Did you?
We're going to Paris by accident during the Olympics. We're going to Paris on purpose during the Olympics by accident. And I did look at the hotel. I couldn't find a hotel, and I couldn't figure out why. I always jump on, a site and go find a hotel, and Marriott, Bonvoy, American. I want to have a gym. I want to have a queen bed and all the other stuff. No hotels. I'm like, oh, we don't usually travel in the summer. We try to avoid the tourism. So this must be the problem. We got one. I finally found one hotel that was available, where my husband and I will have romantically 2 twin beds, and it's about an extra $1,000 over what we would have paid for the same number of days the week before or after. I'm kind of like bummed. But I think it'll be fun. We were in Spain during the World Cup before, and it's kind of fun when the whole country's excited. So I think I heard all the locals are leaving Paris anyway during the Olympics on purpose. They're all leaving, but it should be a very pleasant experience. But I just thought it was funny when you're talking about the pricing. I was like, there's nothing to get, and if you can get it, it's terrible price.
Yes, they're running away because they can rent their flats and on Airbnb and a lot of money.
Yeah.
Because the demand for the flats skyrocketed recently, so everybody wants to do their business on real estate.
Yeah.
Even they are selling the vegetables.
For sure. Has so from your standpoint, out California, anything cooking, Judy? Is anything happening over in your way?
I think most interestingly, I'm going to just go to my own investments, because doesn't everyone love to hear about what regular investors are feeling right now?
Yeah, exactly.
I love triple net. I'm a small investor, just because you guys don't know me so well as David and Amy know me from before, but I'm like a small investor. So I'm like putting in little bits of money into other people's deals. One of my triple net deals last week, they sold for a profit. No, last month, sorry, the end of somewhere in June, they sold for a profit of, I think we got 30% or something like that. And that went sooner than they were expecting to sell. So that was a plan. Actually, the tenant was going to move out, and I had originally picked that one because there was a hospital nearby that said, if your tenant ever leaves, we want that property. And sure enough, the tenant said they weren't going to renew, so the hospital group bought the property. It was like, we knew there was someone in the wings. My other one is tenanted by Amazon. It's with them. That's my other triple net with them. They are starting a fund, and I think I'm going to promote them on LinkedIn because I love those guys. They're nice. I know them. And they are doing very well with triple net. If you get the right tenants in, it's pretty safe, even in these kind of times. People are paying rent. Most of the companies are making money. alternately, I'll just throw, I was in a, I thought it was a debt instrument, but I think it turned out that it is not debt, that it's a credit instrument that is to a company that is a developer that seems to have a pretty good a very, very good track record. I call it a Midas touch. They turn everything into gold. They are product type, whatever, they take whatever makes sense. And that one was paying 12% a quarter, or 12% a year, sorry, paid quarterly. And I was in it for 2 years, and then I re-upped for another year this year, and we have not gotten our March payment yet. And I'm, wah, wah. I would have got my money in 2 years and got out and had my cash back. So that kind of bums me out. They are not being able to get, I don't know what, they are continuing to buy things and to develop. So it's not that they're broke, and I'm assuming I will get my money back. And I actually wrote back to them on when they sent out the latest thing saying, hey, sorry, we just, whatever their excuse was, can't get this one thing done. We thought something was going to sell sooner or whatever. I'm like, as long as I get my money back at the end, that's cool. I don't even care. Yeah. I just want my money back, But I didn't tell them I didn't care about the 12%. But I don't need it in any certain time. It's only a 1-year investment. So hopefully the beginning of next year, it will get my money back, and maybe with my 12%. So that's a couple of mine. I also have some multifamily that one of them I got a dividend on, and one of them we got not a dividend, but we haven't been capital called on it.
So. Well, that's good news, because capital calls are rampant at the moment. So I feel you. I mean,
it's a capital call on a ground up development in Washington, D.C. It's multifamily. And they said that the interest rates and the insurance, which I had forgotten about, kind of how bad the insurance is hurting everyone. They said that they're done with construction. I think they're 60 days behind schedule on construction because of something that happened at the very beginning with the city that they didn't get approval. But they're finished with construction. They are like 20% leased, and they just opened. So they're like leasing. It's going fine. They're like, we really don't have a problem. We don't want to take out some huge loan that's going to take away any chance of profit. At these rents. So they went back and asked everybody for 10% of your original investment, which for me was a very small amount. So 10% was small. So I met the capital call on that because it looks like it's actually fine. And that made me feel pretty good, even though I think you'd be an adult and you meet your capital calls unless you really think that the project's going under.
Yeah, and it just, it's an interesting time right now. I mean, I'm still in a couple of multifamily deals, and they're struggling. I mean, but we're in a variable interest rate. We've hit our cap, and the sad thing is when those variable interest rate loans, what they do to properties is, especially for the smaller investors, is it's the cap that you have to, the lender forces you to buy a cap, and those caps are those hedges against the interest rate. And you're spending hundreds of thousands of dollars, and you're having to reserve for them. So it's your reserves that are getting you, because you're reserving for your next interest payment, you're reserving for your CapEx, and you're reserving for your cap. And they make those adjustments to where it almost kills any sort of cash flow that you might even have during the month, because it's really, really tough. So, your mortgage payment is half reserves for insurance, and then your taxes and your CapEx and your cap. Like, it's crazy town. And so basically you have no cash to do anything with. And it's really tough at the moment, especially on some of those multifamily deals. Yeah.
You find it odd. I find it quite odd that everyone in America, every little human in America, took out a 30-year or 15-year loan on their house when they knew the interest rates were really low, and that all these super smart commercial real estate people did not take a long-term loan when the interest rates were almost at zero, and that now they're facing music. It's like, well, every fool on the street knew to take a long-term loan. Why didn't you?
Yeah, I think it was, I think some people did, but I think a lot of it was, there was a lot of value add repositions happening, or the ones that we were in were all value add. And so they were doing bridge debt. And there was a little bit of a lot of bridge debt happened, right? Because Fannie and Freddie in 20 stopped lending. And so then there was a bunch of, for a little while, they stopped lending. And then there was a bunch of it became the era of the bridge lender. Everybody and their brother became a bridge lender at one point. And there were a lot of debt funds out there doing it, and it just became really prevalent. And they were enticed by the low interest rates and the interest only payments that they could get for several years, and then they could get their construction costs rolled into it, right? And so it was less out of pocket. It was like hard money for a single family flip. I mean, it was kind of similar. So it caused problems because they're higher leverage than they should be on some of those deals, and now their loans are worth more than probably almost the same. The loan amounts they have on their properties are almost at the valuations of what their properties are right now. Like, it's really sad, but that's kind of where it's at.
I will say, for the public guys, I mean, there's a handful of guys that have taken down some 30-year paper over the past few years. But for us, at least in the world of REITs, it's mostly 5, 7, 10-year type of debt that they're taking down, which is pretty standard even for some of the big Wall Street guys, the Microsofts, Intels, et cetera. They're taking down the same type of tranches. And that's kind of one of the things when I say to advisors, when they, when you hear on CNBC or Bloomberg, this commercial real estate wall of debt that's coming due. Well, again, these household names, the NVIDIAs, the Teslas, et cetera, have that same debt that's coming due. And, think about if they're taking down $10 billion or more of debt, the interest expense that they're looking at is frankly more than like the entire market cap of the REIT industry, if you kind of look at it through the microscope. But they're still having to face potentially tens, if not hundreds of millions of dollars of incremental interest payments in a reset interest rate environment today. So it's not just real estate that's exposed to current markets. It's every company, frankly, that's exposed to the current market.
Right. Anybody, most companies, because they all have debt, right? Or long-term issue debt for sure. Yeah, no, I think everybody feels it. No, great point, David. But I'm not sure. So what was do you remember the acronym, Susan, past survive? Like, we can make them up. Survive till 25. Do you remember any of the other ones? Like, is it like, don't be sick till 26? Like, where were they? They're doing something like that, right? Like, I don't know.
I wish that I think I have deleted those emails, but if you follow Biz Now, they have been doing a series, and they actually quote the people who shared them. The people were willing, to share what their quotes were, and they were really very entertaining.
Yeah, hold the gate till 28. I don't know, something. It's gonna be. I don't know. I think I for some reason, but everybody says their crystal ball broke, and mine did too. But I didn't think that the Fed was going to lower rates this year. I know everybody was kind of counting on it, that they were going to lower the rates this year, and everybody's like, oh yeah, they'll do it. They said they were going to do it. And I go, I don't remember anybody saying they were going to lower the rates this year. I think they were talking about it, and I think everybody was hopeful, but yeah. But there was, I think what they were waiting for, and this might be a little politicking, but they were waiting for the higher unemployment numbers, right? Because that's when they know they really kind of hit like where they were at, and they weren't seeing the higher unemployment numbers. And I did see in the news that lately that some of the employment numbers might not have been accurate that came out recently. Did anybody see that in the news? That the past couple of jobs reports were inflated a little bit, like 25% inflated. Did you hear that? Did anyone hear that? So now they're thinking that we have more jobs, or we have more employment than we really do in the US. So, and I wonder if that's politic related. I don't know. Could have been. It's a politics year. It's a politics year.
I have a funny, I have more of my money in cash than I do in real estate. I am a new business. I mean, a business startup more or less at this point, and boy, commercial real estate's not in a great mood to put art into their new projects that they're not developing. But so part of me really wants the rates to go down so that my investments do well and my business does well. The other part of me, this is the first time that I'm making so much money on my money. It's so exciting. So it's kind of a bummer if it goes down, but it's also good. I don't know which way it falls for me.
Oh yeah, I mean, because what you were making on your like regular savings vehicles, you're making like 5 or 6%, right? Something like
Yeah,
that.
and that's, I mean,
Yeah,
that's the money and it's not at risk. And I'm not
yeah,
having to work for it, it just comes in, you know?
yeah. I feel you. I feel you there. That's one of the nice things about that too. Well, we have the couple of the other news stuff that I really wanted to talk about was around this whole thing of, and I don't know, and it would be really kind of good to ask, but AI data centers, right? They're different kind of, they're building, Amazon is building one, they're following, Jeff is following Elon already built his AI data center. We have other AI data centers coming on board, but it was really, I really like to hear from the group on how much AI are you using in your daily worlds, and to kind of understand the amount of the data center expansion. I was just kind of interesting. But yeah.
I'll start on this one. First of all, there was a publicly traded REIT that went out a couple of years ago called CyrusOne, based here in Dallas, acquired by KKR, which I just mentioned earlier. There was a story that hit on Bloomberg yesterday that CyrusOne got a $7.9 billion credit facility to build more data centers because of this AI push. So that's a lot of coin, especially if you think about from the world of REITs. And Cyrus is still considered a REIT, even though it's not publicly traded. None of our REITs are really taken down. Again, unless you're in the S&P 500, you're a Prologis American Tower. Nobody is taking down a multi-billion-dollar credit facility. So that is one point right there to emphasize the amount of AI usage. I use it every single day. Pretty much any LinkedIn post that I'm putting up there these days, or a Twitter post, if I'm able to program, or my daily headlines that I'm putting out there, I'm using ChatGPT like clockwork. Yes, there does have to be some physical interaction because it does pull some noise. You still have to customize it to the various platforms, you know, like tagging the companies and all that stuff. But if I'm able to take this amount of content and make it this amount of content that's easy to digest, and it's copy paste and it's generated in 2 seconds, why wouldn't you use it?
Right.
But I still stand in the camp that the cure for cancer is not going to be found through ChatGPT. That's going to happen through, you know, lab space in an Alexandria property in, you know, Kendall, Massachusetts, or Cambridge, you know, through interaction. Your house, your new home construction ain't going to be done by AI. That's hands-on physical work. You know, everybody talks about work from home, the office going away, etc., because it's being replaced by AI and all this stuff. Pardon my language, I think that's bullshit. It's not happening. So it has impacted our lives on a day-to-day basis, no doubt. But I do feel that there's, you know, industries that are isolated from this that frankly, you know, don't have to worry about it. I'm sitting in my wife's shop. She runs a professional music store, music instruments, again, like your concert symphony, etc. That's not going to be replaced by AI. So, you know, I do feel that a lot of these industries are, again, kind of isolated from what's going on, but in the same breath, it's going to improve our lives dramatically.
Sure. I totally agree. Yeah. Anyone else want to jump in on that one? Go, Hector.
I agree on that. I also think that there are a lot of shifts happening behind the scenes with regards to office in AI, which is a very weird thing to think about. How would AI make using an office different? But just changing the way humans interact with the physical space, we're already seeing examples of talking to a virtual assistant that books your meeting room, finds the next location that's next to your client, arranges the time, puts all of that into your calendar without you having to go to a booking platform or calling a co-working space or seeing who's in the office. You just say, I want to work on this project with this team this week, schedule my slots for me, and it goes in and starts doing that. That is definitely going to change the way that we interact with physical space, and we're definitely seeing examples of that. On the flip side, we're seeing operators and people running offices being able to talk to their floor plans instead of someone getting a request and saying, okay, we need 3 offices next to each other that share a corridor, but also have a close access to an accessible entrance.
you can now ask the AI system that then looks at your floor plans, understands what those lines mean, and returns a floor plan that you can then attach to a proposal. You're taking a process that used to take several, let's say, optimistically minutes, pessimistically hours, and putting it into one prompt, right? So we're definitely seeing both sides of the coin now, really pulling in these tools. Of course, the big problem with that is, do you trust the AI? Do you trust the LLMs? Do you trust them with your data? Give them access to your black book? And it's a lot of work that kind of we're seeing behind the scenes is, how do you create a data strategy for your business that allows you to leverage AI without giving away the boat or giving away the farm, as some folks say. And that's the interesting thing we're seeing. Definitely a lot of cool tools, a lot of functionality coming, seeing a lot of people getting away from their screens and back to what they were hired to do. But we just got to be a bit careful. We're seeing a lot of data leaks, a lot of breaches, a lot of things like that we still have to kind of keep back of mind as we roll out these new technologies.
Yeah, very cool. I mean, Susan, I'm sure y'all are using AI in what you're doing, and I think it's interesting. I'd love to see how you're doing it, and I think there's also a cybersecurity in with AI, right? So that'd be interesting to see what y'all are doing too.
It's really interesting. And one thing I wanted to bring up when you were talking about data centers, going back to the original question, is I heard a statistic last month that today data centers use 4% of all power generated. In 2030, they estimate it'll be 9%. I mean, that's mind-blowing. The 4% alone is pretty mind-blowing. 9% in 6 years from now is really, really crazy. And we've been talking a lot about generative AI in this particular discussion, but we really haven't focused in on all of the machine learning work, which is, a subset of AI that's going on in our industry as well. And I think that's where there's tremendous opportunity that the machines are going to really help speed up decision making. And I think that's something that we're really excited about at Elm, is, looking at what are the possibilities, things that, it would take too many people too much time to figure out, and you're really starting to take more advantage of predictive analytics and where we think things are going to happen, so that we are a position to react, or can react before the rest of the market knows. I think, the companies that are investing in things like that are going to be the haves, and the ones that aren't are going to be the have-nots, honestly.
Right, for sure. Do you have a data scientist on your team?
Yep. We do not have anyone with the title data scientist. So we don't, have anybody that's a degreed data scientist. We do have some really strong research people on our team that work very closely with some technical analysts on my team in IT, but no formal data scientists. But I know there are some real estate companies who do.
Yeah, for sure. I think it's going to be kind of a new thing, right? For sure, that comes on board at some point. Yes, ma'am. Go, Judy, go.
On your prop tech stuff, Amy, this is truly a question, but are you working on things like where the building's power and everything is controlled by AI, so that you're not wasting energy when there's nobody in the room and all that stuff? So I would think, that's part of real estate costs that I think are going to be well controlled. If you want to share on that, but.
Yeah, you can tie the occupancy sensors in. I mean, it's not just like movement, but you can use occupancy sensors in a really cool way to understand, like, over time, trending that data on how many people show up at certain places and where do they go in the building. So therefore, those are the lights that go on, right? And you can do really super cool things with occupancy sensor data, and then just not like you're tracking people, but you're not tracking who they are and what their personality is, and like, but you're just you're tracking use of the building. Let's put it that way. Let's just say it in a better, nice way, so people don't feel like they're being watched all the time, but they are. But and it's about tracking use of the building so you can use your energy in a better, more efficient way. It's basically what's happening. But yeah, there's a lot of that can be done now. and especially with facial recognition. You can use facial recognition for access control. You don't need keys anymore. You don't need any of that kind of stuff. People can take a selfie of themselves, and then they'll recognize, it'll recognize, and they'll go into, like, say, an elevator, and it knows what floor they're supposed to go to, and it'll just take them to that floor. I mean, you can do super cool things like that with facial recognition and understanding who's in the building and where they're in the building. And we were talking the other day with that company that does that facial. They're out of Israel, and they're moving to the US. But you know, we're trying to formulate a use case around facial recognition and access control for schools. And so you could stop, you know, potential school shooting scenario that could happen because you could use that facial recognition, identify a threat, and cordon it off using, you know, how they do the doors. That was one of the use cases that we're working through. And I'm just like, it's amazing what technology can do and the things that it can solve. If you kind of put it that way. Yeah, David.
One of my favorite examples, I don't know if you're familiar with what's going on with Madison Square Garden and the company that owns all the Madison Square Garden venues, but they have facial recognition software. As somebody who has seen many a Fish concert at Madison Square Garden properties, where if they have somebody that's on the ban list, the do not allow access list, they can find them anywhere in the arena because they know when they've come through security because of the facial recognition. But there's been some great stories about somebody is suing Madison Square Garden. The attorney is on the ban list. The attorney's daughter was going to some ice skating show with the Girl Scout troop, and she walked in and within seconds was approached by security saying, sorry, you're not allowed in the premise on the grounds. And, you know, it's, I mean, I know, I hate to say it, but Big Brother is watching, no matter how much Big Brother is always watching.
Yeah, I know for sure. It's interesting to see how, you know, how the technology, and it, at the end of the day, it's really, you're trying to solve for cases where, you know, there's, you know, all the schools shooting thing is super cool. The other thing too, and one of the things we're able to do with kind of AI and understanding is we're building out this with kind of like with New York City now. I'm putting in a thing around with the building lab. New York City has a building lab, and I don't know if y'all know this, but the Department of Buildings is creating a building lab in New York City, and they're reaching out to technology companies, early stage and later stage technology, to present to them new ideas on how they can better manage the buildings, right, in New York City or whatever. And one of them is around the first responders and how understanding when a first responder is responding to a fire at a building and it doesn't have a good digital twin of that building, it's basically walking in blind, right? Or if it doesn't have know where the hazardous substances are, or if there's an AC leaking, that is a hazardous substance. If you got Freon leaking and there's a fire, that's bad news. And they might have to evacuate a block depending on what kind of Freon's leaking or what kind of, you know, gas or chemicals leaking. They don't know. And so there's a lot of stuff when the first responders walk into a building that they don't know. They have no idea, and they could be putting themselves and where the whole neighborhood in danger. But tech can solve some of those problems, which is super, super cool. I'm so excited to kind of see where that goes. So that's, you know, that's awesome. And I know over in Europe, Emil, like the ESG push and everybody's kind of feeling that regulation pain from around the ESG side. But are you developing differently now than you have in the past couple of years? What are you looking at now?
From the marketing point of view, yes, we are developing in the another way because, in fact, I cannot feel the special differences. There's more green marketing, green ESG, more green marketing, more ESG marketing that it was used to. There are more compliance policies for my subcontractors to, let's say, to be aligned with. More pain in the neck, let's say, for all of stakeholders in the process. But we have to prepare because within a few years, probably it will be absolutely impossible to get the financing from bank to roll up the credit, to roll up the financing of operational financing, or get the financing for construction, if we wouldn't have ESG taxonomy policy and that kind of thing. So
it's being tied to the financing
yeah.
now. It's interesting.
It's financing is for let's say convincing the possible tenants. Okay, we have a green building on the cross. It's green on the crossway of it. Let's come to us because thanks to us you will have no problem with the green. Okay, no financial reporting, etc. etc. So we are selling, we as developers selling this as green marketing for it, as an incentive, green incentives for the tenant. We are getting an advantages speaking about the financing. But what in the end, what I wanted to say that we are acting, me as a project director, I'm acting the same like 3, 4, 5 years ago, where I wanted to achieve the BREEAM or LEED certificate on platinum level or outstanding level. So there are more papers, more bureaucracy, more pain in the neck, as I said before. But the outcome in the end of the day is it's the same from the construction, from the design point of view. And okay, we have to act like this to be, let's say, accepted by the market. As I said, tenants, banks, or like BNP Paribas, one of biggest bank in Europe, in continental Europe. They are spreading the information that they want to do any financing within 2 years for the companies who's got the footprint on some level. Yes, exceeding the level. It's a qual that you don't get the financing. That's
interesting.
And it's getting more complicated in the end of the day because Belarus, okay, Ukraine, it doesn't count at that time, but Belarus, Kazakhstan, Azerbaijan, Turkey, they have no such a policy, but there is a huge supply of let's say of the subcontractors, of the projects, of the products, which but they don't need to be aligned with such a policies as I mentioned, as I listed before.
I see. Okay, so that complicates it even more. Yeah, it's interesting.
Yeah, we are fighting with something, but we are doing as Europeans. We are doing too fast with this. We are dealing too fast with this. This is my personal opinion. It would be better to get much more, let's say, smoother but still significant way of doing this, because it's causing that it's much more difficult to fight with the markets, like I said, Turkey, Belarus, Azerbaijan, where ESG means nothing.
Yeah, I know. So you got to comply, and they don't. So it makes it interesting for sure. Yeah, that's awesome. Well, that's cool. That's a really cool perspective. So we're almost at the top of our hour. So I just wanted to spend the next 3 minutes, let everyone say a few parting words, and but this has been a great show. We're going to put this on every week. This is a part of the U.S. PropTech Council. We are sponsored, and we also are sponsored by Lerner and Associates. Lerner and Associates is a real estate technology mergers and acquisitions consulting company, which is founded by Ben Lerner, and he's proudly sponsored the U.S. PropTech Council. So I do need to give him props for that. And I will start with Susan on an outro. Any parting thoughts, Susan?
I just hope wherever you happen to be in the US or in the world, stay cool, because it has been miserable here in the DC area. So wishing you cool weather and the right amount of rain.
Yeah, I feel you. Yeah. And Hector?
Yeah, I mean, you took the sweat off my head. I mean, yeah, it's really, really hot. Stay safe out there. To our friends who are impacted by the recent hurricanes and storms, stay safe, stay dry, and just wish everyone has a great week until we're back next week.
Yep. David?
Everybody's being all serious. I was just going to say,
I know.
buy REITs.
Buy REITs. Buy REITs.
If you're looking for a REIT job, check out www.allthereitjobs.com. And yeah, buy REITs.
Buy REITs. All right, Judy.
Someone did call the bottom of the office market, and I hope they're right, because I wish everyone good fortune in their commercial real estate ventures.
Oh, they did call it. That's right. I saw someone call it. And Emil?
Stay cool, stay positive. It was really nice to see you again in this company, and with the live view. The weather in Poland is like 35 degrees, and I'm coming to Florida within 3 weeks, so it will be even much more hotter.
Yeah. Don't melt into a puddle.
I cannot wait. I cannot wait, actually. after our winters we have. So I cannot wait.
That'll be great. Yeah. Enjoy your time in the States. It'd be great. And this is Amy, and we're signing off. All right. Have a good one, everyone. Thanks for coming to the show. See you next week.
See you next week. Bye-bye.